Inflation eases, but not the pain in the housing market. Welcome to Market Insight. I'm David Pollard. The housing market continues to struggle for a sustained recovery. Data today shows single-family housing starts, which account for the bulk of home building, slipped last month. Permits for future construction were also down. This as the 30-year fixed mortgage rate pulled back from a 5-month high last week, but to a still elevated 7.09%. Yesterday's NAHB Wells Fargo Home Builder Index fell unexpectedly in May for the first time in 6 months, as home loan rates kept customers on the sidelines. Well, let's get a view on all that from First American chief economist and housing specialist Mark Fleming. Mark, many thanks for joining us. Welcome today. Let's first of all get your reaction to all those numbers that we had from the sector over the last 2 days or so.
Well, clearly, where you started with housing starts, that's actually mostly multifamily starts, not single family. Single family sort of went sideways, but multifamily went down. And that's largely because multifamily sector essentially overbuilt for a couple of years and are delivering an awful lot of units, actually 1 million completions recently, into a softer rental market. And so the pullback on multifamily starts is sort of this fear of, well, we might have built a little bit too much too soon. In the short run, that will ultimately fade, obviously, in the long run. When it comes to home builder sentiment, I think the higher rate environment, makes, buying down mortgage rates for home builders more expensive. It creates fears of affordability. And so generally, the animal spirits, if you will, around housing are, lower rates will be better. And I don't know that we're going to get those anytime soon.
So mortgage rates obviously a big factor there. Are there other factors at play too?
Obviously, price levels are there. And as we've talked about before, inventory levels. And so while demand might be waning due to higher rates, prices are not necessarily, certainly not declining in most places and still going up because there's just so little supply. And as we started with, not a lot more building happening. So it's a mix of supply constraint and affordability issues on the demand side.
Now, inflation appears to be a little bit more benign, according to yesterday's April CPI report. But as you point out in your notes, inflation in rental costs could still be moving upwards, and the shelter component of CPI is, if anything, more aggressive.
Yeah, and the shelter component of CPI is big. It's over 40% of the entire basket. So it's a primary reason why the overall CPI numbers aren't coming down faster. We know that the component of measurement lags the real market by 12 to 18 months. But 12 to 18 months ago or 12 months ago, rents were coming down, house price appreciation was significantly slowing. Fast forward to today, the CPI shelter component is still catching up, but rents have stabilized and in some markets are going up again. So there's a significant headwind to one of the major components of the CPI and the PCE because it uses the CPI shelter components in the fact that there's not a lot of deflation in the housing market at the moment.
Let's look at the broader picture. The jobs market has, of course, been very supportive for the US economy, but are there signs of the US consumer, especially those who need housing? Is the US consumer beginning to crack under the burden of high inflation and high rates?
I think to some very modest extent. Clearly, for the last couple of years, the strength of the consumer has been the bellwether of the economy, largely due to all the pandemic-era savings being basically drawn down, and that's mostly gone. We do see rising delinquencies modestly in credit cards and student loans and auto payments. And so, yes, maybe ever so hairline fractures rather than cracks may be appearing to the consumer. But still, writ large, the labor market is very strong. If you want a job, you can probably get a job in this economy, maybe not in all sectors. And that's sort of been holding up the one side of the dual mandate of the Fed, actually.
Well, talking about the Fed, where do you think we go from here on interest rates and inflation? We've had a number of policymakers over the last couple of days indicating they're simply not ready to cut rates.
Right. And we started the year thinking lots and lots of cuts. That faded because inflation went sideways. Now we got a relatively good overall inflation report, but I don't think it's enough to really change the needle of we're going to rush and do a rate cut in June. The stay higher for longer. There's no cost for the Fed at this point to stay the course because as we just talked about, the dual mandate is basically stable prices and stable labor markets. And if the labor market continues to hold up, then they can keep working on the mandate of inflation and just wait for it to come down. So it would only be a significant hairline fractures turning into real cracks in the economy to sort of draw the requirement to cut anytime soon.
Okay, Mark, we'll leave it there. Mark Fleming of First American, many thanks for being with us today. That is your Market Insight. You can watch more videos on Reuters.com.